Hello, I want to talk a little bit today about financial ratios. I'm going to go ahead and pull up the screen here. And what financial ratios are is they're a great way to judge different aspects of company performance. Um, Also, financial ratios typically allow for companies to judge performance of different size parts of the company. Typically, financial ratios are used to look at performance on the company on the whole, but also segments and parts of the company. And again, they kind of take away a lot of the size advantage that some parts might have over others. So, for example, a company like Walmart could compare their largest supercenter with their smallest neighborhood market and get a good comparison between the performance of the two by using financial ratios. Now, one thing with financial ratios, kind of as an overview, companies tend to look at them, like I said, their own performance, but a lot of times also they look at them against industry averages. There are organizations out there that prepare financial ratios, kind of industry averages for different financial ratios. And a lot of times a company will see how they're doing against industry averages, against leaders within their industry, and kind of another way to use financial ratios. Now, one thing with financial ratios, and you'll see here, you've got an income statement and you've got a balance sheet that I've kind of made up here. And financial ratios tend to look at different numbers off the income statement and the balance sheet and use those as a way to judge financial performance. And so you see here just a very basic income statement that I've prepared. You see net income, sales, gross margin, operating expenses. You see operating income here, income tax expense, and net income. And then I also have 2 years of a balance sheet here for 2020 and for 2021. And then I have a column here for average where there's going to be some areas with financial ratios where an average is going to be taken. And that's basically you would just take your ending total from the prior year plus the current year, add them together and divide by 2. And so where an average is needed, I prepared it off to the side here. And so you see just basically total assets, liabilities, stockholders' equity. Like I said, a very basic example of a income statement and a balance sheet like you would have seen before. I also put a couple of other things here that might be used with some financial ratios, and that is the current market price of the stock and the weighted average common shares outstanding, in this case, 100,000. So let's look at some financial ratios. Now, typically most textbooks will have different financial ratios in the chapter, and then they'll have typically a summary at the end of the chapter. You want to use whatever your book spells out as far as formulas to use for different ratios. If you go online, sometimes you'll find a little bit of variance in the formulas that are used for some ratios. So stick with whatever the book is showing you, because that's what will be applied to assignments for the class and assignments based on the class. It'll be whatever the book is showing you as far as formulas. So follow the book. I used here some ratios that are pretty common that you see that are pretty common ones that are used. And I'll talk about each of them and work an example based on the numbers from the income statement and the balance sheet that we just looked at above. Now, we've got different types of ratios. The first group is going to be liquidity and efficiency ratios. Liquidity and efficiency ratios are basically ratios that deal with kind of short-term cash situation and the efficient use of assets. So that's basically, what is your short-term cash position and how efficient and efficiency of operations? That's really what it looks at here. So the first one would be the current ratio, which would be current assets divided by current liabilities. And so basically, we're doing this for 2021. So we would go up and basically on the balance sheet, you would take your current assets, which was 120. We would divide it by your current liabilities, which are 175. Or excuse me, your current liabilities, excuse me, which are 43. That would be your current liabilities. And we would get basically a current ratio of 2.79. So with this ratio, this is a ratio that looks at what is a company's ability to use their current assets to pay their current debts? What is a company's ability to use their current assets to pay for their current debts? So a current ratio of 2.79 just says that the company could use their current assets to pay off their current debts 2.79 times. So, and again, companies kind of use these a lot of times to set goals. These are a great way to set goals. Like if a company wants to make sure that they've got plenty on hand to cover, their short-term debts, they would want to have a higher current ratio. So they could use that to set like an internal goal. Again, they could compare it with industry averages. What's the average company in our industry doing? What are some of the leaders in our industry doing? And so the current ratio is a good ratio. It's used both by companies, but it's also used some by like banks or financial institutions if a company goes for a loan, because it's a telling statistic in relation to a loan, because again, it's looking at what is your ability to make payments on short-term debts. Now, you've got inventory turnover, and this is more of an efficiency ratio. For this one, you're going to take the cost of goods sold, which comes off the income statement, and you're going to divide it by the average inventory. So we would go up here and we would look at cost of goods sold, which is right here, 500,000 on the income statement. And notice again for this one, I'm going to use the average inventory. And remember, if the formula calls for an average, you just take last year's plus the current year, add them together and divide by 2. So in this case here, we would take the 500,000, divide it by the 36,000, the average inventory that we just saw, and we would get 13.89 times. So what inventory turnover tells us is how many times throughout the year did the company sell their complete inventory. So when it comes to inventory turnover, the higher the better, because the more times that you're selling your inventory, the more you're moving inventory. And remember that some companies really, they make their money off moving a lot of inventory, like Walmart. Walmart does not charge as high a markups as some companies, but they make their money by moving a lot of merchandise, a lot of inventory. And so for some companies, that's really the key to their success. Now, a couple of other things I will tell you real quick about financial ratios. One is that with financial ratios, as you can see, they always follow a formula. And you just want to, whatever the formula says, you go to the income statement or the balance sheet and you figure what the ratio is asking for based on those. You see in every case here, we've had a formula to follow. Another thing I'll kind of say about financial ratios, and this is something you'll see, is that financial ratios, some apply to some types of companies more than others. Like, for example, this inventory ratio that we just did, it applies very much to some manufacturing companies, merchandising companies, retail companies. Wouldn't apply probably as much to a service company because they might not have any inventory. But so one of the things you're going to notice is that some of the financial ratios apply more to some industries than others. So, and remember, they're all a formula. You just basically follow the formula if you want to figure out or get the answer to or to find these ratios. Now, the next one we're going to do is days sales and inventory. And this is 365, which is the number of days in a year, divided by the inventory turnover ratio. So what day sales inventory looks at is how long does it take, how many days does it take for a company to sell their complete inventory? So in this example here, we'd take 365, we would divide it by the inventory turnover that we just came up with right above it, and we would get 26.28 days. So what this would tell the company is that it takes them a little over 26 days to sell their complete inventory. So that's really not a bad number. That's that would be, this would be a number that, again, a company would set a goal. A company would say, for us to be profitable, we need to sell our inventory this quickly. And they would set a goal, and they would use these two ratios, inventory turnover, days sales and inventory, to determine, are they meeting that goal? Or if they're trying to improve and move inventory more quickly, they could use this as a way to see, are we improving? Are we meeting these new, tougher standards? So again, that's a big way that companies use financial ratios. They set goals, they use it to see if they're meeting those goals in various different areas of performance. Okay. So another one here would be total asset turnover, which this would be net sales divided by average total assets. So for sales, we would go up to the income statement, and you see here 700,000. And for average total assets, we would go down to the balance sheet, and you see here you've got 2020 plus 2021. You would have an average total of 712,500. And so this would be something that so then they would come down and they would do the math, and you see 0.98. So what total asset turnover tells a company is, how well are they using their assets to generate sales? This would again be more of kind of an efficiency ratio. How well is a company using their assets to generate sales? So basically what this would tell the company in this place is, for every dollar this company spends on assets, they generate about 98 cents in sales. And so again, this would be something that a company would look at, okay, what is our performance? And is this something we can improve? And then they would use this kind of as a guide to see, are we improving our performance in that area? Now, next group would be solvency ratios. And solvency ratios relate more to a company's ability to pay their long-term debts. And so there's one I wanted to work here, and it's the debt ratio. And it's total liabilities divided by total assets. And what the debt ratio tells a company basically is, what percentage of their assets are financed by debt? What percentage of their assets are financed by debt? And so we would get total liabilities up here off the balance sheet right here, and we would get total assets off the balance sheet as well. And how companies, kind of how I've seen companies use this, is companies typically try to keep their debt within certain limits. Because a company, just like an individual, if you get too much debt, it becomes a greater risk. It could hurt your stock price. It could make you riskier, because even when times are bad, you've still got to make payments on debt. Same thing for an individual. And so it lessens the amount of risk the lower this is. So some companies just kind of set a goal, like, we never want our debt ratio to be more than 50% or 40% or 60%, whatever they feel comfortable with. And they'll use this ratio to make sure that they don't take on more debt than they would like to take on. They can also, again, use this with industry averages to see, okay, how is our debt compared with some of our competitors, or within our industry? So a lot of different ways that a company can use this. This would also be a ratio that would be used if a company went for a loan on the outside, just looking at, okay, what percentage of your assets are financed by debt? Some companies are more comfortable with having more debt than others. So again, different companies would kind of use this ratio in different ways as far as examining their debt position and where they want it to be, or where it is currently. Profitability ratios. These are ratios that look at the profitability of a company. How profitable are they? Um, and they look at it in kind of a different way than just looking purely at generating in net income, for example, or cash flows. So first one is going to be the profit margin ratio. And this would be net income divided by net sales. So both of these come off the income statement. And what we get here is 4.57%. What the profit margin ratio tells a company is what percentage of every sales dollar makes it through to the bottom line net income. What percentage of every sales dollar makes it through to the bottom line net income. And so this would be, again, very useful to a company because the more that makes it through to the bottom line, the better off they are. And it also looks at kind of how well a company manages their expenses and cost, because again, the more that makes it through to the bottom line, the better off they are. Now, we also have gross margin ratio, which would be the gross margin divided by net sales. Now, if we go back up to the income statement, right here, we would have gross margin divided by sales. And remember that gross margin is calculated by taking your sales minus your cost of goods sold. Remember that your cost of goods sold is the cost of all the items that you sell. What do these items cost us as a company? And so your gross margin is really your markup. It's how much are you marking up your goods? Because think about it, sales, what you sell the items for, cost of goods sold, what those items cost you. So gross margin is really your markup. So if we take our gross margin and divide it by our sales, what this is telling us is how much are we marking up our goods. Now think about it this way. This is an important ratio for a lot of companies because some companies, like I said earlier, we're talking about inventory turnover, and some companies make money by basically marking up, by basically moving a lot of merchandise. They don't mark it up much, but they move a lot of product. Other companies make money by higher markups. You know, you think about like Tiffany's of New York, a lot of your very upscale retailers, they make money off higher markups. They don't move as much product, but they make a lot of money when they do. And so this would be an important ratio for a lot of companies. And some companies look at this as that we need to produce or have a certain gross margin or a certain markup on our goods in order to maximize our profitability or to meet our goals as far as profitability. So again, this would be something that would be watched by a lot of companies. Now, have another one here, return on total assets. This would be net income, which is the bottom line of the income statement, divided by your average total assets. What return on total assets tells a company is for what they've invested in assets, what kind of return is that investment generating? And so this one is used a lot as far as bonuses, as far as goals for different parts of the company. This one is used quite a bit. And this one is used for different parts of the company, like segments of the company, and even the company on the whole. This is a great measure of performance. Because think about it, if you're managing a Walmart supercenter and there's so many assets tied up in that store, you could take the net income that store generates, divide it by the investment and assets in that store, and you could get for what the company has invested in that company, what kind of return is that investment generating? And so this is a great measure of performance and often used for segments of the company, often used as far as giving out bonuses, performance evaluations, and like I said, also examined from a purpose of the company on the whole. For what we've invested in assets, what kind of return are we generating as a company? So again, companies use this quite a bit. Another one I wanted to talk about here is basic earnings per share. And this one is used a lot in relation to the stock market and stock gains. You know, companies are examined, their performance is examined by Wall Street a lot of times based on their earnings per share. the amount of income available for each share of stock owned by the stockholders. And so the formula would be net income minus preferred dividends. Now, most companies do not have preferred dividends. So for most companies, preferred dividends would not be would not be factored into this equation. But if they do, it would be factored out of net income. The reason being is they want this to relate more to common stock and to kind of take out the effect of preferred stock. Now, not many companies have preferred stock. So again, this is not going to be a factor for most companies. Now, the weighted average common shares outstanding, typically it's going to be given to you. But if you had to figure it, it would just be based on taking a year. You would look at, okay, based on this year, what was the average number of shares outstanding? That would be basically how you would figure this. So basically net income was the bottom line of the income statement. And I actually gave you here the weighted average common shares outstanding of 100,000. And so what we looked at here was earnings per share of 32 cents. So based on 32,000 of net income and 100,000 shares of stock outstanding for the year, then earnings were available at 32 cents a share for the stockholders. So that would be your earnings per share in this case. Now, the market prospects, we had a price earnings ratio. What market prospects are these are financial ratios that look more at market performance, stock market performance. And what the price earnings ratio looks at, again, is it's the current market price of the stock divided by the earnings per share. What this tells an investor in a company, these are also a lot of times very good for investors as well. They'll look at these when looking to invest in a company. What the price earnings ratio says is what multiple of earnings is a stock selling at. And if a company is selling at a very high multiple of earnings, it might mean that the market is looking to more of the future in relation to the stock, or it might mean that the stock is overpriced, depending on how you look at it and in different ways that it's examined. It's hard to get a really good, there would be multiple meanings behind this ratio in the real world in relation to making investments. But basically the market price per share divided by the earnings per share. So in this case, the market price per share, I gave you $75 a share right here. And the earnings per share, 32 cents a share. So this stock would be selling at a price of 234 times earnings, which that would be a pretty high PE ratio. So again, what this would mean is either the market is justifying this based on they have a lot of future potential for this stock, or the stock is overpriced. And like I said, it could kind of be viewed either way by potential investors, so but yes, this is what multiple of earnings is the stock selling at in the marketplace currently. It's a way to kind of justify as a stock overvalued or undervalued in the marketplace as it is now. Okay, thank you. And financial ratios, again, a great way to judge performance. And you really just want to follow whatever the formula says for them when doing them. In relation to the income statement and the balance sheet, all your information is going to come off the income statement and the balance sheet, except for certain market information, which I gave you separately in this example, but a problem would also give you. Thank you, and have a great day.